Welcome to This Explainer. Today, we're diving into something super fascinating. It's Adam Koo's exact 8 criteria checklist for finding genuinely great businesses and then buying them at a massive discount. Look, if you've ever felt totally overwhelmed by the stock market, you are in the perfect place. We're going to break down the 8 criteria of buying a great business at a great price.
So let's kick things off with a brutally honest question. When you invest, are you buying stocks or are you just buying lottery tickets? Because let's face it, so many people treat the stock market exactly like a casino. You know the type. They act on hot tips from a buddy, they buy when everyone is hyped up, and they just kind of pray the price goes up. But a master investor, they know that when you buy a stock, you absolutely aren't gambling on some flashing ticker symbol. You're buying a piece of a real, functioning company.
And that brings us to a core philosophy championed by master investors, including the legend himself, Warren Buffett. He says, if you don't understand it, don't do it. Simple, right? But it's so powerful. True wealth in the stock market isn't about getting lucky. It's about thoroughly, deeply understanding the actual business behind that ticker symbol. Here's our quick roadmap for today's explainer. 1. The master investor mindset. 2. Identifying a great business. 3. The wide economic moat. 4. The financial health check. 5. Buying at a discount. And finally, 6. Knowing when to sell.
All right, section 1, the master investor mindset. Let's get right into it. There is a totally stark contrast between your average investor and a master investor. The average investor basically acts entirely on emotion. They're momentum-driven, meaning they buy on good news when prices are already soaring and they panic sell the second there's bad news. But a master investor, they're the exact opposite. They're patient, logical, and, get this, they actually prefer to buy on bad news when prices fall. They rely on strict criteria instead of getting swept up in market hysteria.
Moving on to Section 2, Identifying a Great Business. This master playbook is really a two-phase journey, and it perfectly captures our main focus today, the 8 criteria of buying a great business at a great price. Phase 1 is all about identifying that phenomenal business using the first 7 criteria. Then Phase 2 uses that final 8th criterion to figure out exactly how to get that great business on sale. So let's look at those initial checks for a truly great business.
The crucial thing here is looking at both the past and the future. Criterion 1 demands a history of consistently increasing sales and earnings over at least 5 years. You want predictable past earnings, think of a juggernaut like Anheuser-Busch, rather than the crazy erratic swings you see with average companies. But hey, the past just isn't enough, right? That's where Criterion 3 comes in, requiring concrete future growth drivers. Are they launching new products? Are they expanding their capacity? Entering new markets? A great business always has a clear, actionable plan for future expansion.
Now for Section 3, the wide economic moat.
So what is a wide economic moat? Basically, it's a sustainable, competitive advantage that heavily protects a company's profits and its market share. Imagine a medieval castle. The wider the moat around that castle, the harder it is for invaders to breach the walls. It's the exact same in business. A wide moat ensures that competitors just can't steal your customers away, even if they try to undercut you on price.
You can think of wide moat businesses as essentially consumer monopolies. We're talking absolute powerhouse brands like Coke, Nike, or Microsoft. They can safely raise their prices because they have immense brand loyalty and high switching costs. People are just going to keep buying them. On the flip side, you have narrow moat businesses. Think airlines or internet service providers. They're essentially selling commodity products, which forces them to compete almost entirely on being the cheapest option. Master investors, yeah, they avoid those price wars. They invest in the wide moats.
Section 4, the financial health check. Let's look under the hood.
All right, Criterion 4 is all about debt. A really great company needs to have conservative debt. Specifically, their long-term debt should be less than 3 to 4 times their current net earnings. To put that into perspective, it simply means that if a massive recession hits, they can still easily pay off what they owe without going bankrupt. It's an absolutely crucial safety net.
Next up is Criterion 5, which looks at return on equity, or ROE. This just measures how efficiently a company is using shareholder money to generate profit. Master investors are hunting for a consistent ROE of greater than 15%. And this perfectly ties into Criterion 6, low capital expenditure. You really want a company that doesn't have to constantly pour all of its profits right back into expensive machinery just to stay afloat. They should be generating high returns while still having plenty of cash left over for actual growth. And let me tell you, finding that combo is a beautiful thing.
Which brings us right to Criterion 7, the management. Listen,
You can have the greatest product in the world, but bad management will absolutely drain the company dry. But it's actually surprisingly easy to spot the difference. Honest, competent leaders, like, say, Sam Walton at Walmart, who famously flew economy, they keep their basic salaries reasonable and they tie their own wealth to the company's stock performance. On the other hand, dishonest or incompetent management, they'll drain the company with huge expense accounts, they'll quickly sell off their own stock, or they'll even use shady accounting tricks to hide losses. You definitely want a management team that acts like true owners.
Moving into Section 5, buying at a discount. This is where it gets really fun.
This introduces Criterion 8, ensuring the stock is actually undervalued. To pull this off, you absolutely have to understand intrinsic value. Simply put, this is the true underlying worth of a company, based on the actual cash it's going to generate in the future. The literal stock market price, that fluctuates wildly above and below this intrinsic line, usually driven by pure human emotion. The entire goal of the master investor is to make sure the share price you pay is substantially lower than that true intrinsic value.
So, how do we actually get that massive discount? Well, think about this. What happens when genuinely good companies face temporary bad news? Maybe there's a broader economic recession, a temporary dip in quarterly earnings, or some overblown scandal in the media. The average investor completely panics and sells. But to you, that is not a disaster. That is a massive opportunity.
Let's use a quick supermarket analogy to build out this strategy. If your absolute favorite toothpaste costs $3 and suddenly it goes on sale for $1, you don't panic and run out of the store, right? No, you stock up. The stock market is exactly the same. You wait for that irrational panic to drive the price down, you know the true intrinsic value, and then you execute on the 8 criteria of buying a great business at a great price. Buying at a discount gives you what we call a margin of error. Even if your calculations are slightly off, that deep discount protects you from losing money.
And our final section, number 6, knowing when to sell.
Master investors do not sell just because the stock price gets a little wobbly. They sell based on strict logic. You sell if you realize you made a fundamental mistake in evaluating those first 8 criteria. You sell if the company permanently loses its wide economic moat to a competitor. You sell if management suddenly starts acting dishonestly. Or you sell if the market becomes so incredibly euphoric that the stock price shoots way above its intrinsic value, making it severely overvalued. The rule of thumb, you sell when the business fundamentals change, not when the stock chart changes.
And that basically wraps up our explainer. You now fully understand the 8 criteria of buying a great business at a great price. You know how to spot that wide economic moat, run a financial health check, and buy when temporary bad news creates a sweet discount. So the final challenge for you is this. Looking at the world around you right now, where will you look for your first great business? Take this framework, stop gambling, and really take control of your wealth-building journey. Thanks for hanging out with me on this explainer, and happy investing!